because people know that, they're trying to time the market and get everything that they want. It feels like there's a whole bunch of latent demand on the sideline that's waiting, hey, as soon as interest rates go down, I'm going to jump in so I can get these prices that haven't gone up as much as they used to, but I want to do it at this new rate.
Yeah.
And what we continue to say is that once you're doing that, once you are getting greedy when everybody else is greedy, it's going to be too late. If you are waiting to buy real estate right now, you're waiting for that interest rate to drop, you're doing what everybody else is doing. You're moving at the pace of the Fed.
Yeah.
Right?
Yeah.
I think everyone's waiting for the Fed to make this decision to tell them what to do, but I've just never seen a good example of waiting for the government to tell you at what speed you need to move for your business. And this whole demand that's on the sideline is waiting for this to happen instead of thinking like a not your average investor, instead of thinking, you know what, this idea that the rate's going to go down, I can use this to my advantage. I can get in right now with this price, with this rate, and then wait for the rate to go down and refinance later, as opposed to getting in once the thing starts going crazy again, which is what the Fed is trying to prevent.
Mm-hmm. This is the talking point of this year. It is using this information to set yourself up for success in your real estate portfolio. And it's this knowledge that we're sharing that when interest rates go down, home prices go up, which has been documented over decades. We've shared the data on the show. So whereas it was a few years ago, we talked about the deal was the debt. And I was saying, guys, listen, interest rates were so low. Like, you got to lock in right now.
Yeah.
You got to buy because interest rates are so low. This is the message for today, which is lock in right now, not because interest rates are so low right now, but because of what happens to pricing when interest rates come down. You are setting yourself up to buy and own real estate at a lower cost basis today. Because if you believe the data, over decades, that has shown that when interest rates go down, home prices go up. By locking in today at a higher interest rate, you're going to lock in for a lower price. And then it's not going to cost you much at all just to refinance. This isn't even an idea of like being fearful or greedy, in my opinion. It's just a lack of understanding. It's a lack of knowledge.
Yeah.
Because in other countries, you don't have loans in place that you can just refinance without penalty. Here in this country, you can buy it. The interest rate's higher today than you want, but all you do is you just refinance in 6 months, a year, 2 years. But now you probably save 10 grand, 20 grand, 30 grand, 50 grand of equity.
Of actual price.
Right, of
what you're
actual
buying
price. Yeah.
It makes me think two things, GC. It makes me think we're so conditioned in other asset classes to buy the dip.
Right.
And that it perverses our mentality for real estate, because there's no dip in real estate. There's only like stable moments, and then it goes up at faster rates. And to me, the equivalent of a dip in real estate is when interest rates are high and where prices are. Because the moment that interest rates go low, it's going to rise, right? So like, to me, the equivalent of buying the dip in real estate is buy right now when interest rates are high so that you can refinance the dip.
Yeah.
Right, of interest rates.
I like that.
And then the other part that I think about is, unlike other asset classes, real estate is uniquely positioned in the sense that if what you're worried about is inflation, you buy real estate.
Yeah, exactly.
Right? So why wouldn't you be like making this move right now? Why are people not having the clarity of mind of understanding that, listen, if the Fed is worried about something, you probably want to be worried about it too. It's inflation. And therefore, you want to be investing in asset classes that have proven to mitigate your exposure to inflation and also actually profit from it, which is what you do when you lock in debt at a certain dollar value that's going to perform well over time for yourself. And then B, the dip for when you buy in real estate is when you buy at a certain price point with higher interest rates, because what's going to dip is the interest rate. And as the price continues to go up, you refinance there and you're locking that in.
Gosh, I like that.
You like that, right?
The change in the perspective of what does buying the dip mean in real estate? Dude, I think you're onto something there.
Right?
I like that.